Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was going through the comments section. The question is, do you think that ETFs will significantly underperform a portfolio of stock picks or just somewhat? And I chose uranium for this example. Uranium has a select few, we'll call it a lot less to select from than, say, precious metals companies or something like that. So this person also comments, but as you said, things can go wrong with mining companies. So I guess an allocation plan to diversify, but not too much, would be important with a question mark. What I'm going to touch on is just the performance differences. I'm using uranium as an example. I'm going to use the ETF URNM, which is an ETF against a whole bunch of different single individual companies that I think are pretty decent companies. They're all developer companies. There's no producers in it. So I just chose some of the developers and some of the companies that I hold in my portfolio. So here we go. I'll jump in here. So I've got it pulled up. You're going to lose me here. So the blue line is North Shore Global Uranium Mining ETF. That's the blue line. And in this example, on the left-hand side, these are some of my favorite companies. Baseload's an explorer. They're exploring for, obviously, uranium, but they are underperforming North Shore Global. And then the other ones, Deep Yellow, Encore Energy, and Forces Metals, are vastly outperforming the ETF. So even if I equal weighted these guys here, I would be vastly outperforming the North Shore Global ETF. Now, when things develop and we go further into the future, and if the uranium price continues to go up, I suspect on a longer term horizon, over the 5 years or whatnot, that some of these companies are going to vastly outperform the ETF. I mean, vastly. On the right-hand side, I've got more companies here as well. All of the companies that I have in my portfolio here are outperforming the North Shore Global ETF on these picks. Going on down, these are also, dark blue line is the North Shore Global ETF again. These are some more of my picks that I have that are more exploration type based. We do have Fission Uranium in there, and we got Uranium Royalty Corporation. All of them have outperformed except for Fission. Fission's underperforming a little bit. And then on the right-hand side, here's some more American companies. They are also outperforming every single one of them, the ETF. So it's very difficult to, I guess, underperform the ETF, apparently. And Bannerman, I didn't put Bannerman in here, but that's another one that I've overweighted. I overweighted Bannerman. I recently, before this pullback, did more in Forces Metals, Encore Energy, Deep Yellow. Those are some of my favorite ones. Global Atomic and Goviax. What's important here is the outperformance could be so vast that getting some money in the best performers in this area, I think, is critical. So, and portfolio allocation size is definitely something that you want to do. You might allocate only a few percent to each position. And it might even be a very small percentage in relationship to an overall portfolio, depending on what you want in your portfolio and the allocation you want to put towards uranium. If it's a very small allocation, then you might have to do an ETF. If you have a good enough amount of money, I would say I would look at potential individual stocks. The way that I am writing this is I have the majority in individual stocks. And I'll even have some exploration companies with a little bit of money in them. So that's my take. And that is a certain percentage of 20% of my overall net worth. So 20% of my overall net worth is in very highly speculative stuff. We'll call that the swinging for the fences portfolio. And my uranium holdings are in the swing for the fence portfolio. Same with my high debt, high leveraged oil companies. Same with some of my copper and silver picks, and gold and precious metals, all that stuff. So I have a big mixture of swinging for the fences. My other portfolio, which is more 401k based and some retirement stuff, I do hold mutual funds in that with precious metals. I do own some mutual funds with energy and healthcare and stuff like that. So I do have some, but I'm not swinging for the fences. I also have in some of my retirement accounts a lot of royalty companies, which I consider to be less risky, but also can return very well. So that's like a Franco-Nevada, Wheaton Precious Metals, and all those types of things. Now, looking at the swing for the fences portfolio, if some of these companies return 10 or 20x, I don't know if the North Shore Global is going to get that anywhere near that. So if you have one of those and one of them kind of underperforms some, the outperformance of the one that does outperform is going to transform your portfolio into something else. It's going to bring your returns way up there. And if you have one or two that of an exploration company that you just put a little bit of money in and they hit something big, they do like a 200x or a 500x or some ridiculous find that they find during a commodity, during this commodity bull market or the uranium bull market, you're gonna blow up that portfolio with just a small allocation. $1,000 could turn into a few $100,000. And it's possible. Doesn't mean it's likely. It's possible that one of these companies finds something big. And hopefully it's easy to mine. It's even more value for the shareholder. So that's what, fingers crossed, maybe we can get in early on the next gen. But it's highly possible, and I think one of them's highly likely. One of them's going to find something. And I think ISO Energy probably found something. I don't know if it's easily mineable, but they found something that I think is probably a good find. So my take is, with how asymmetrical this bet is, with still how early we are, and with how big the returns could potentially be, I think having a few individual picks would be a very smart thing to do. What those individual picks, I can't tell you what it is, but I can tell you my opinion and some areas to look at. I really like Encore Energy. I like the Namibia African companies. Bannerman, BNNLF, Forces Metals, FOSYF, Deep Yellow, DYLLF. I like Global Atomic, GLATF, which is not Namibia, and then Goviax, GVXXF. And Encore is ENCUF. You could do some research into those. Those are not, I'm not trying to push these to anybody. Do your own research. See if it fits within your strategy. You can ask a financial person, are these good companies? They're probably going to tell you that they are highly speculative, which they are, and they don't have any income right now. So they do carry a lot of risk. If you want to carry less risk, which I think is another good way to play it, is UROY, Uranium Royalty. I think that one's a really good bet for a risk-adjusted return. They have royalties on some of the larger mines that Cameco has. They've got other royalties as well. It's basically a way to diversify their income through a whole bunch of different projects that they've put money and loaned money to those projects, and they get a stream, a 1% net smelter return of income when those go into production. So I think that's another good way to play it if you want a lower risk, high return strategy. So Uranium Royalty Corporation. If you guys like this content, give me a thumbs up. Thank you for listening. This is Finding Value.